I enjoy watching fitness videos while listening to financial earnings reports, and I hope others will like this combination too. In the annals of American grand strategy, military force has always been a subordinate instrument to our most potent weapon, the exorbitant privilege of the United States dollar. The recent Memorandum of Understanding between Washington and Tehran, which brings an end to the hostilities that began in February, should not be misread as a sudden softening of American resolve. Rather, it is a masterstroke of traditional realpolitik, necessary and decisive pivot to protect the architecture of global financial hegemony from its only true systemic threat, the Chinese yuan. For the past several months, the blockade of the Strait of Hormuz and the freezing of Iranian assets achieved a tactical military objective, but precipitated a profound geo-economic vulnerability. By fully exiling Iran from the dollar-based financial system, Washington inadvertently accelerated Beijing's long-held ambition to de-dollarize the global energy trade. Under the weight of our sanctions, Tehran had no choice but to pivot entirely to the east. China gladly assumed the role of monopsony buyer, absorbing roughly 1.4 million barrels of Iranian crude per day at a steep discount. More alarmingly, these transactions were insulated from the SWIFT system and settled exclusively in renminbi, or through primitive barter arrangements. Iran's attempt to leverage the Strait of Hormuz by permitting passage only to vessels trading in yuan was not merely a wartime provocation. It was a proof of concept for a parallel Beijing-controlled global financial infrastructure. For the stewards of American capital, allowing a petroyuan ecosystem to mature was an unacceptable risk. The foundation of American economic supremacy, our capacity to project power, and the stability of our treasury markets all rest upon the undisputed role of the dollar in pricing global energy. A protracted war in the Middle East that actively pushed resource-rich nations into China's financial orbit was a strategic misallocation of American resources. The June Memorandum of Understanding elegantly corrects this trajectory. By lifting the naval blockade and offering to waive sanctions on Iranian oil exports, the United States is not capitulating to Tehran, it is reclaiming the chessboard. By allowing Iran to re-enter the dollar settlement system, Washington is effectively neutralizing the Sino-Iranian financial axis. The yuan may serve as an emergency refuge for rogue states, but it cannot compete with the liquidity, convertibility, and scale of the dollar. The estimated $20 billion to $50 billion of Iranian oil revenue currently trapped in Chinese banks' funds rendered practically useless to Tehran due to the friction of secondary sanctions serves as a stark reminder of the renminbi's limitations. Given the choice, Tehran will naturally abandon the restrictive and deeply discounted Chinese market to sell its crude at global benchmark prices, settled in the world's reserve currency. True power requires the discipline to recognize when a military conflict undermines a broader financial imperative. Ending the conflict with Iran is a triumph of pragmatic statecraft over ideological entanglement. In drawing Tehran back into the dollar ecosystem, the United States has severed a vital artery of China's economic expansionism, reasserted control over global energy markets, and ensured that the business of the world continues to be conducted in American currency.